everybody. Jason here from Two Sides of Fi. Got a couple things right off the top. First of all, you've probably noticed Eric is not here today. He's not on the screen. And that's because he was called away last minute to deal with something. He's fine. Don't worry about that. Because number two, I'm very happy to be joined today by Sean Mullaney, who many of you in our audience likely know as the Fi Tax Guy from his blog of the same name. Now, Sean is a CPA. He's had a long career in public accounting at some very big name firms, and more recently has his own business where he works as a financial planner, offering fiduciary, fee-only, and advice-only financial planning. Sean, I just want to welcome you to the show. Both Eric and I are very familiar with your very useful blog and appearances elsewhere, and I'm just glad to have the opportunity to speak with you.
Jason, it's great to be here today. Looking forward to our conversation.
Now, a reminder that all of our listeners should be familiar with already, but of course, our goal at Two Sides of Fi is to provide education, information, and if we do our job half right, entertainment. And this discussion, like any that we have here, is neither financial or legal advice. Of course, there are, you can build relationships with others if you have questions about your own portfolio, but I still think you're going to find plenty of value in the things we talk about. Now, naturally, there are many areas in which taxes are essential to consider and plan for on either side of Fi. And today, our aim is to talk about some tax-related topics that Eric and I have had and discussed either in part on the show or offline, but also some things that we see bubble up frequently in the community, whether it's on our channel or elsewhere. So maybe I'll just start with a big wide open question, Sean, if that's okay with you, and say, when you think about the FIRE community, a group you've interacted with plenty, what do you think are some of the big tax misunderstandings that are just commonly out there?
I'll give you two, Jason. Okay. First is taxable assets are bad, right? And it turns out taxable assets are actually really good, particularly in early retirement. Why do I say that? First, it gives you runway. So when you're early retired and your taxable income, it looks artificially low. So you start working on your tax return like, hey, wait a minute, I'm poor. I didn't know I was poor, but the IRS at least thinks I'm poor, right? So drawing down on taxable assets can be very helpful for a couple reasons in early retirement. One, it helps you control your taxable income so you can do Roth conversions. You take your traditional retirement accounts and affirmatively transition those to Roth accounts and maybe pay some tax on that.
Yeah.
But you then have the taxable assets to fall back on and live off of, right? Because we want to do tax planning, but we also want to have something to live off of, right? That's pretty important too in early retirement, right? You got to eat, right? So that's one thing. Second thing about those taxable assets that I'd say is, guess what? They may not be all that taxed in early retirement. Why do I say that? Right? If you own things like domestic equity mutual funds, international equity mutual funds, I think you're going to find that if you can keep your taxable income in the 12% federal bracket or lower, guess what's going to happen? You're going to have a situation where most of the dividends that are generated qualify for the 0% qualified dividend income tax rate, and your capital gains will qualify for the 0% long-term rate. So I think, it's both sides of Fi, right? When we're in our early retirement, we should be thinking about living off those taxable assets first. And when we're more like Eric, where we're trying to get to early retirement, we should be thinking about maybe we should be building up some of these taxable assets so we have this in our early retirement. So our early retirement can look like I live off mostly my taxable assets, and I keep I manage my taxable income. So maybe I'm paying a 0% tax rate on long-term capital gains, qualified dividend income. And then on the side, I'm doing some Roth conversions while I'm still getting the benefit of maybe the standard deduction, the 10% and the 12% bracket. So I think that is a big misconception out there that, these taxable assets aren't so good. Well, I think early retirees are well advised to have at least some to start off that early retirement.
Yeah, that's a really great point. It certainly hits home for me because in early retirement, I am now 49, started when I was 47, stepped away from the workplace. I have a taxable brokerage account, and of course that is what I view. Some people call that a bridge strategy or other terms, but that is literally what I live on presently, that my family's grocery bills are paid with. And so it certainly resonates with me. I think I do like that the idea of the 0% capital gains ceiling has become more widely known. It seems like something you hear, actually spoken about now, which is great. But you also made a point there on the dividend side that there are considerations as well. And I think that's perhaps less understood. Is there a little more color you could add there about how that is to be the case, very often?
Yeah, so we have to start off with the difference between interest income and dividend income, right? So
Yeah.
interest income, generally speaking, comes from savings accounts, bonds, bond funds. Now, when you get it from a mutual fund, they call it a dividend, but it's
Right.
really just interest, right? You report it as a dividend, but it's an ordinary dividend, does not get this qualified dividend income treatment. But when you have equities, right? So stocks of different companies,
Yes.
and as long as you have a decent holding period on it, and it's either a U.S. company or a company headquartered in a country the United States has a income tax treaty with, which is most
Okay.
of the big companies, but not all of them. The dividends that flow through every year on your tax return are called qualified dividend
Right.
income, and they are taxed like long-term capital gains. And so you may be familiar with, there's a rule in the tax laws now that says, okay, these long-term capital gains, if you're in the 12% or lower tax bracket, right? So you've managed income in such a way, guess what? You get a 0% long-term capital gains tax rate. So your
Right.
qualified dividends also suffer a 0% rate. Now, Jason, you're probably familiar with, in the great state of California, there's probably going to be some California tax on that.
That's
But
right.
if you're managing income, you're actually going to still be at a low California tax rate too. So it's not 100% free, although it depends where you live. If you're in Washington, Nevada, Tennessee, Florida, Texas, that could be a decent segment of the audience. Guess what? No state income tax either. So so these things can be very impactful. And if you're able to live off these taxable assets, now you have this Roth conversion opportunity,
Yep.
because you don't, it's one thing to say, oh, I got all my money in a traditional retirement account. Well, you might have to take money out to live off of, right? And you may not be able
That's
to do
right.
so much Roth conversion. But if you're taking money from a taxable account, so let's say, Jason, you and your wife live off $60,000 a year out of your taxable accounts. Well, if you take it from cash, there's no tax on that, right?
Yep.
There's no capital gain on cash. And maybe Jason's sitting on a mutual fund, right? And he's got a $40,000 basis and it's now worth 60,000. Maybe not a great 2022 hypothetical, but let's just run
Right.
with it, right? Well, the taxable income to Jason and his wife isn't 60,000, it's 20,000.
Right.
60,000 of proceeds when you sell it, less the 40,000 of tax basis. And there are a number of reasons why I've got a thesis that says, yeah, let's spend down those taxable assets first. Part of the reason is because that basis is getting inflated away over
Right.
time, right? Jason's $40,000 basis in the year 2022 is worth more to him than his $40,000 basis in the year 2032. So why not sell while that basis is high in terms of inflation? I think that is, that's another opportunity presented by using those taxable
Yeah.
assets first in early retirement.
That's a great point. And this whole topic and Roth is something I have some other questions on, but it fits nicely into a recent post of yours that I quite liked, and I'm going to link in the show notes. I think it was called, or it was about tax optimized drawdown strategies in early retirement. And these are a couple of them. On the topic of Roth conversions, I know that there's not going to be I suspect you're not going to be able to give me a very, very simple answer for this, and it's not going to apply to every situation. But I do think there's a lot of confusion, at least this is my read, about Roth conversions and early retirement and how to really think about them. Yes, there's the tax now versus tax later aspect, and that's really one of the central issues. And if you're managing your income, right, how much conversions to do. But I guess my question at high level is, how would you guide people to think about Roth conversions, and what kind of work should each of us do to think about our own situation and how Roth conversions could be a sensible strategy for us to investigate or otherwise?
Great question, Jason. So I would start with the process, and then we can talk about some
Okay.
guardrails. So for the early retiree, I would recommend doing the Roth conversions in the fourth quarter. Why do I say that? So October, November, December. First reason I say that is that Roth conversions are not reversible. It
Right.
used to be that they were reversible. You could do something called a recharacterization, and there was a
Right.
game to be played with that. That game has been, canceled, right? The second
Right.
you do that Roth conversion, that's it. It's a Roth conversion. It's taxable. So I don't like this idea of let's wake up on New Year's Day, log into our
Oh
account, and do
yeah.
Roth conversions, right? In theory, there's an academic argument to do that because you get more time of tax-free growth, but I like flexibility. So
Yes.
if I'm an early retiree, what I do is at the beginning of the fourth quarter, I look at, hey, what did have the previous 9 months look like, right? Did I have some maybe part-time self-employment income or W-2 income? Is there any pension income going on here? What have the interest, dividends, capital gains look like during the year? And what can I expect for October, November, December? I've got at least some visibility into that. Heck, I could just pull up last year's brokerage account and say, oh, December of last year, this thing paid a 2% dividend. Well, what might that look like this year? Maybe I'd be a little
Right.
conservative, right? And I can essentially start in a spreadsheet constructing my tax return for this year. And what I do is I start constructing that tax return in a spreadsheet. And separately, I Google the IRS tax brackets and the standard deduction, assuming I'm taking the standard deduction,
Yep.
90% of Americans now do. So that's a decent assumption, right? Your mileage may vary. But I start putting this all together and say, well, wait a minute. Where am I on where am I in terms of what my tax return is going to look like without additional planning? And how much runway might I have, say, in the 10% tax bracket, the 12% tax bracket? And maybe I start doing some Roth conversions to fill those things up. Now, that's a basic process. Some things to be considered, right? One is the further you are away from that 72, the more impactful the Roth conversions can be. Because part of what we're
Right.
trying to do is hive down our traditional accounts so that we have lower required minimum distributions, the dreaded RMDs in our 70s, 80s, and 90s, right?
Right.
So, boy, I'm early retired. I'm 49 years old. I get just a little bit from traditional to Roth this year. That's going to help my future self and perhaps my spouse right after my death because there'll be less RMD to be taken in the 70s and 80s. That's one thing to think about. Another thing to think about is something called the premium tax credit. Now, look, if you're not on an Affordable Care Act plan, you don't need to think about this, right?
Right. Right.
But many early retirees find themselves on an Affordable Care Act medical insurance plan, including Jason.
Yeah.
And this is actually a little bit of a double-edged sword, right?
Yep.
So on the side we don't like is for many early retirees, Roth conversions are going to suffer a reduction in this premium tax credit. The premium tax credit is generally based on income.
Right.
And the higher we juice up our income, the lower our premium tax credit is going to be. And for many Americans, as a very rough rule of thumb, we may suffer a 10 to 15% surtax on our Roth conversions because every dollar of Roth conversion creates modified adjusted gross income, which lowers, by roughly speaking, 10 to 15 cents on the dollar, that premium tax credit. So that's something to consider.
Yes.
However, I said it's a double edged sword. On the other side, we may need to do Roth conversions to qualify for a premium tax credit. Well, what the heck is that about?
Yeah.
The rules say that if one qualifies for Medicaid, in California, it's called Medi-Cal, I believe, right?
Yep.
So if
Yep.
one qualifies for Medicaid, and that's determined based on income in each state, there's some variability there, then one does not qualify for a premium tax credit. So in theory, somebody who doesn't have enough income can't get a premium tax credit. Now, in theory, they could still have the ACA plan, but that's a full freight charge, right? A family, of four could be paying 20,000 plus for medical insurance with no subsidy on this premium tax credit. That's a really bad outcome.
Right.
So, and most folks do not want to be on Medicaid. Doctors don't like Medicaid because it reimburses low, and so you now don't get the best of attention. That's a whole other conversation. But generally speaking, most early retirees do not want to be on Medicaid.
Right.
So, what you can do is you can affirmatively do these Roth conversions and create taxable income, create magi, and now you get above your state's threshold to not qualify for Medicaid.
Exactly.
I believe in California, it's 138% of federal poverty level. I was looking at the numbers recently. In California, if you're a family of four in the year 2023, to get off Medi-Cal, which is essentially California's Medicaid, you're going to need something like $40,000 worth of income, right? Yep. Below $40,000 for that family of four, they're on Medi-Cal and can't get an ACA premium tax credit. So how would an early retiree in that situation create the income to get off Medi-Cal and turn on premium tax credits so we get on our ACA plan and get a big, juicy premium tax credit so our premiums are very low? Do some Roth conversions,
Yep.
right? You have this ability to create taxable income and control income. So it's these Roth conversions, when we marry them with the early retiree premium tax credit, are a bit of a double-edged sword. And so you got to do your own analysis. But
yes,
really sort of an interesting time to be an early retiree. Let's put it that way.
It is. No, I appreciate that level of detail. I think that a lot of people on the FIRE path, particularly those much younger, aren't thinking about all of those issues. And, it's something Eric and I have talked about a lot on the show because I think there's a balancing act that is essential to do. And that's a very tight way of wrapping up something that you explained in much better detail. But, you do have these different factors you need to think about. And it's a privilege to be able to have the opportunity to think about these factors, but it doesn't make it any less important to think about where am I from a total income perspective, what is looming in the future in terms of potential required minimum distributions. Do I have an outsized, IRA account or, 401k, any of these accounts that are going to be subject to RMDs? What am I doing for health insurance? How do I think about all of those things? For me, what I have found to keep my mind at ease, and I'm not saying this is the only way to do it, but from what you've just said, Sean, it sounds like you might not disagree. I have a spreadsheet going all year, and any income that we generate, whether it's from dividends or whether it's from the 1 day a week fund job that my wife and I each have, anything like that just goes into this one spreadsheet, and I can see where I am so that by December, when I talk to my CPA, because full disclosure here, I do see the value in talking to somebody who's a tax expert, and that makes me also sleep a little better. I'm not going to make a huge mistake. But just like you suggested in that fourth quarter, for me, my meeting is early December. I'm going to know where I am with income. I have some line of sight on the dividends that still haven't manifested in December, and will be the best armed to make a decision about Roth conversions for this year. And I already know what the limits look like in terms of ACA and, how I want to think about that. So it is a little bit of work to do. I was just talking to my wife about this yesterday, but it's well worth it to do this little bit of legwork. And, getting help can really make sure that you feel confident about it. But, there is, none of it's particularly complex, but it's all important.
Yeah, and Jason, you mentioned in a previous episode that I believe you have a high deductible health plan through the exchange. Is that correct?
That's correct.
The HSA, you have an opportunity. So one cool thing about the HSA is you don't have to be working to contribute to an HSA and get that tax deduction. Right. So, I'm not giving you personal advice here, but boy, you have a nice little tactic there where you're saying, okay, I'm going to contribute to an HSA, which lowers my income. And then maybe you could do, say, more Roth conversions. And, you're essentially getting two benefits there. You're getting money to an HSA, tax-free growth. That's fantastic. And then that can shelter another 7,700, 8,700, whatever it might be in your case. In your case, 7,700 probably. But, you can shelter another 7,750 of Roth conversion by that HSA contribution. Now, don't get me started on California and HSA. That's a different conversation.
Yes,
but
and New
federally,
Jersey.
you're getting a big tax. Yeah, you're getting a big tax benefit.
Yeah, it is. It is. Despite our delightful weather, we don't not getting the triple tax advantage on the HSA is something I like to think someday will change, but I'm not holding my breath. For those, whether they're early retirees or otherwise, just what are things that you think people need to make sure they're cognizant of when they think about end year tax planning, and that being wrapping up the current tax year as well as preparing for the next year ahead.
Yeah, a couple of things on that, Jason. One, the best planning is lifetime planning. It sounds like you yourself are doing lifetime planning, right? It's great to optimize for any one particular tax year, but the best planning is, year-round and holistic type tax planning. That said, I think you should be thinking about a couple things. One is, what does this year look like versus the next few years? Is this year
Yeah.
unique in any way? Did I get a huge bonus at work? Am I going to early retire next year? Am I taking a big charitable deduction? Those sorts of things. You just want to think about, is this year a little different in either
Yeah.
direction? And that then can inspire some year-end planning. Another thing to be thinking about at year end is, am I going to be taking the standard deduction or am I going to be doing itemized deductions? And am I on the precipice? Am I close? Now, look, 90% of Americans now take the standard deduction. So there may not be a ton of planning that can be done here, but maybe you add up your home mortgage interest, your state income tax, which is state taxes, which is now capped at 10,000 per return,
Yep.
and your charitables that you've made during the year, and you say, boy, I'm really close. Those things add up to almost the standard deduction.
Right.
Well, you could think about things like a donor advised fund. That's one of my favorite little tactics out there
Yep.
where, hey, I'm otherwise charitably inclined. So maybe every week I give to my church, or I have favorite charities I give to every year. And so what I can do is I can accelerate the deduction for those contributions by parking the money in a so-called donor advised fund. So I contribute to that. I take a tax deduction this year for that. And then over the next 3, 4, 5 years, I dole out the money to the charity in the normal course of how I would have otherwise done it. So the charity sees very little difference.
Mm-hmm.
What you see is you get a deduction up front. So you now have this 1 year where, hey, I've got this big, nice, juicy tax deduction. And then in the following years, you just go back to the standard deduction because you were probably going to be taking that anyway. You're going to be real
Right.
close to that anyway. And it's a way of it's a way of increasing a deduction, but also moving it into the present as opposed to having it be in the future. So it's a way to juice tax deductions. And then one other piece on that donor advised fund is, if you're sitting on an appreciated stock position, you might want to donate the appreciated stock. So,
Yeah.
you bought tech company stock 40 years ago. It's gone through the roof. You got this big capital gain. Nobody wants to pay capital gains tax.
Right.
Well, instead of selling that stock and donating money to a charity, maybe you take 10 shares of it, put it in the donor
Yeah.
advised fund. You get to take the tax deduction at the fair market value, so at today's value.
Right.
But so you get that deduction, and two, you wash away that capital gain. So that could be something to be thinking about. So yeah, for year end, I'd be thinking about, is this year different from other years, and does that drive some tax planning? And really be thinking about that standard deduction versus those itemized deductions.
Yeah, no, that's really great, Sean. It does remind me of one other tax year related topic that I think is important to consider, and certainly has been on many people's minds and many different financial content creators episodes in recent months, and that's tax loss harvesting. Now, that's a topic we've talked about on this show before. Eric and I have both, unfortunately, like many people, had plenty of opportunity to do tax loss harvesting this year, capturing those losses either to offset gains, not so much this year, or in future years, as well as ordinary income. But you caught my eye on this idea of specific bond-related strategies where tax loss harvesting can be very relevant. Maybe you talk about that. Kind of using bonds to optimize. Sorry, I worded that poorly.
So it's the year 2022, and lots of folks have losses in their portfolios.
Right.
And one area where this can come up is bond funds, right? If you think about end of year, even in 2020, right? Not too many people had losses, even at the end of 2020 in their bonds. Maybe they had some losses or some very small losses. This year, a bunch of folks have some built-in losses in their taxable brokerage accounts in bond funds. Well, this creates a little bit of an opportunity, a two birds, one stone type opportunity. Let's think about bonds for a second. Bonds are sort of leaky, right, from a tax perspective. They generally have higher yields than equities. So, right, for example, I own $1,000 of a stock mutual fund. It probably pays maybe a 2% dividend yield. So that's
Right.
$20 of income. If I own 1,000 of a bond fund, it might pay like 3%. So that's maybe $30 of income. So it tends to produce more taxable income than equities. The other thing it tends to produce, like we talked about earlier, is ordinary income. So
Right.
you basically tack on that income at my highest marginal rate, and that's the tax rate I pay on that. Versus if I'm in an equity fund, I pay that qualified dividend income rate on most of the income. So maybe I can get a little better in two ways here. Maybe I
Hmm.
find a bond fund in my taxable portfolio that has a built-in loss. I sell that. Now I trip a capital loss. I put that on my tax return that can shelter other capital gains. I can deduct
Right.
that against other ordinary income up to $3,000 every year. Any unused losses go to next year. I'll deal with it then, but that's a $3,000 potential tax deduction. Okay, that's nice. But I also get a second benefit, which is I get that $30 of interest income every year in my $1,000
Right.
example off my tax return. And maybe I reallocate in the taxable brokerage account into equities, right? So now I'm putting, instead of $1,000 generating $30 of ordinary income, maybe $1,000 is generating $20 of qualified dividend income. So I'm a little better on my tax return. And this doesn't mean I necessarily have to change my portfolio allocation,
Right.
right? So what I could do is look to my 401k or my traditional IRA and see if I could maybe do the opposite transaction in there. Now I have to navigate this wash sale rule in terms of the loss,
Yes.
but maybe I could find a somewhat different bond fund and essentially buy, take some equities, sell those in my traditional IRA or my 401k, and buy this different bond fund. And now I haven't changed my portfolio allocation, but I've put more of my bonds in my traditional retirement accounts where it's going to be ordinary income anyway. I don't
Right.
care about, so it's going to be ordinary income anyway. And I get to defer it at least to 72. I have at least some control over that, right? Yes, RMDs, but a tax deferred is a tax cut. So that's good. And then in my taxable, I'm generating this qualified dividend income, which is going to be better on my tax return, right? So two birds, one stone. I just think
Right.
this year, 2022, is the year of bond and bond fund tax loss harvesting for at least some Americans.
One of the things that viewers of our show will likely have picked up on over time is the different paths that Eric and I each took to FI. And my show partner, Eric, while he started his career in traditional architecture practice, eventually went out on his own, started his own business, which he still very much operates today, although the breadth of things that his business covers these days in terms of content creation and education and all these other angles is very much a real thing. He is a strong believer in solo 401ks and the extreme value that they have for solo entrepreneurs. And in fact, you've written a book on this topic, so I have the expert in front of me. Could you tell us a little bit about your recently published book, Sean, and how solo 401ks are a tool that more people need to be thinking about who have their own businesses?
Yeah, thanks, Jason. So I like to say with the solo 401k, I'm both a pusher and a user, right? And it
Okay.
reflects my story in terms of, until age 40, I worked a W-2 job. I had a career at large employers, great. And then I made a transition and I started working for myself. And
Right.
when you work for yourself, you don't get that email from HR saying, hey, here's our 401k plan. Please
Right.
pick your investment allocation and your contribution percentage. That doesn't
Yeah.
happen, right? But that said, when you work for yourself and you qualify for the solo 401k, which most people who work for themselves do, not everybody, right? And I talk about that in the book, but most folks who work for themselves qualify for this thing. It gives you tremendous opportunity in a number of ways. I'll just mention two here. One is now you get to pick the investments and the financial institution, right? So when you work at a large employer, great, but you're limited to their financial provider and
Right.
the 20 or 30 investments on the menu, right? Now that you control the solo 401k, you can go find the provider, you can go pick the investments, control the fees. Solo 401ks tend to have very low fees. It's a
Right.
really good opportunity for solopreneurs. The second thing is now you're in control of the contribution level in two ways, right? One, you have those employee contributions, just like you had at the old job, right?
Right.
That's fine. That's tremendous. And for the year 2023, it's 22,500 max as an employee contribution. Up that to 30,000 if we're age 50 or more. So that's good. That's where solo 401k looks very much like the large employer 401k. Great. Employee contributions, got it. Well, what about those employer contributions? Remember
Right.
those matching contributions at work? They're great. Think about a W-2 worker, $100,000 worth of salary. And the employer says, you know what we're going to do? On the first 6% of salary, we'll offer you a 50 cents on the dollar match.
Right.
That's great. I'm going to take a gamble here and do a little math on a podcast. $100,000, 6% match. 50 cents on the dollar is $3,000 by my math, right? That's
Believe you're
great.
right.
That's fantastic. $3,000 from my large employer into my 401k. Well, guess what? When you're working for yourself and you have this solo 401k, you can do a lot more, right? The only constraints you have are one, your cash flow, to be fair, right? We can't put $1 billion in there because we don't have $1 billion in
Right.
cash. Um, and the IRS limits. And generally speaking, that same person, if they're Schedule C now, they're self-employed, they're working for themselves. As an employer, they could put another 18,500 into the solo 401k. So that's a big advantage to
Yeah.
those folks. That person could get in the year 2023, they're under 50 years old, something like $41,000 into the solo 401k. They couldn't have done
Right.
that at their workplace. And by the way, we love to talk about limits, right? Particularly in the personal finance space. What's the limit? How much can I do? Well, maybe you can't do the limit, and that's okay too, right? So maybe one
Right.
year it's 10,000, the next year it's 15,000, the next year it's 41,000, 45,000, right? Maybe we go to the limit the next year. These solo 401ks are just a tremendous opportunity in terms of tax savings, which is great, but also getting a big retirement account that could then fund maybe like an early retirement or geo arbitrage or whatever it might be. I
Right.
think this is just an opportunity that, for whatever reason, has not gotten enough attention. That's part of the reason I wrote the book.
In a SEP IRA, are there times where that makes sense? Is it income related? And I know every individual situation is different, but at least relating it to this conversation about a solo 401k.
Great question, Jason. So I think for most solopreneurs who qualify for both the solo 401k and the
Yeah.
older SEP IRA, the solo 401k is preferable. Why is that?
Right.
Main reason is just contribution limits, right? So SEP IRAs and solo 401ks are identical in that they have employer contributions, right? So in that $100,000 Schedule C income example, we're looking at 18,500 and change in terms of a max SEP IRA contribution or solo 401k employer contribution. Okay, great. But where the difference comes in is this employee contribution,
Okay.
where the solo 401k has employee contributions could be up to 22,500 in the year 2023, up that to 30,000 if we're 50 or older. SEP IRA doesn't have that employee contribution. So for many solopreneurs, the solo 401k is just going to offer a much higher limit in terms of what we can get in there. Now, does that mean the SEP IRA is always the wrong answer? No. For example, I'll give you one example where maybe the SEP IRA is just as good. Maybe a side hustler.
Okay.
So, someone has a W-2 job with a large employer. They've got a good 401k, low fees, good investments. The person is just perfectly happy maxing out 22.5 in the employee contribution to the workplace 401k. Well,
Yep.
okay, if you do that, that means the only contribution on the table for the side hustle, solo 401k or SEP IRA, is an employer contribution. So in that case, there's not going to be any difference between a solo 401k and a SEP IRA in terms of contribution limits. And if you're not worried about some other tax planning, something like the backdoor Roth IRA, then the SEP IRA is just fine. And, okay, go for it. So there can be times where the SEP IRA, and I will say administratively, the SEP IRA is a little easier to manage. Not that the
Okay.
solo 401k is splitting atoms, but it does require a little bit more administrative detail and attention than a SEP IRA. So there can be times, particularly in the side hustle context, where maybe the SEP IRA is a little better. But for many solopreneurs, I think the solo 401k is the winner just because of those contribution limits.
Great. No, that really helps. Actually, I find with all these different retirement vehicles, there are a lot of questions out there. I suspect you probably spend a decent amount of time fielding questions like that. One, it's a little tangential to this, but one that I see come up all the time is even just how people can begin that thought process of, well, what is my prioritization of different
Yes.
types of accounts? And I know asset location isn't a trivial, thing to just, put a nice little bow on, because there's a lot of reasons you might have, access to certain things and not others. And maybe this 401k plan makes sense and I'm going to maximize that. But like, when do I think about the Roth? And I don't know if there's a kind of an easy way to tee that up, at least to help people go do the research they need to do. But your thoughts on that, I think, would be really helpful.
Yeah, and of course, I'm going to toot my own horn. I'm shameless, right? So I do have a blog post on fitaxguy.com on fire tax strategies for beginners, right? So that's a resource. Look, there are other resources out there as well. I would start with the idea of the employer match, right? Most
Okay. Yeah.
beginners are not self-employed. Now, some are, right? And there are resources such as my book, but let's say most folks are just starting off W-2 job. The first thing you want to be thinking about is that employer match, right? So in
Right.
your 401k, like I said, maybe they say for the first 3% of income, we'll match dollar for dollar or 50 cents on the dollar or 25 cents on the dollar. Well, that's free money and that's
Right.
an instantaneous return. And nobody's going to beat an instantaneous return. So you might as well get that, grab that. And oh, by the way, you're now building up some savings because you put your own skin in that game, right? So that's where I would start. And then I would think about something like a Roth IRA, particularly as a beginner. The Roth IRA is, it's tax-free growth and it can do some double duty. Not that we want it to do double duty, but it can. And that is as an emergency fund as we're building up our wealth.
Right.
Because you can withdraw your old contributions to a Roth IRA at any time for any reason, tax and penalty free. And they come out first under the distribution ordering rules.
Got it.
So look, you can take your old Roth IRA contributions out of your Roth IRA, go to Vegas and blow them gambling, right? You should not do that, right?
Right. Right. I
But
would
you
agree.
can. But what if you had a real emergency? Maybe what you
Yeah.
do in life is you start building up that Roth, you start stabilizing your finances, and then on the side you start building up the emergency fund. Look, emergency funds have a role, and I'm not here to tell any particular person in this audience should you prioritize emergency fund over Roth, but I think you can think about, well, wait a minute, the Roth could be my emergency fund at least for part of my life. Not necessarily an optimal way to approach things, but it's a possible way to do it. So I would say, start by thinking about the employer match and then start thinking about things like a Roth IRA. Those are like two get your feet wet ways of proceeding. And once your feet are wet, you're going to find all of this becomes easier. Not that you're an expert, not
Right.
that this is no more research, no more analysis, but boy, just those two things alone can really get you going in terms of your financial future.
For people on a fire path,
Yep.
just what are some examples of things where they may want to do a check-in with an advice-only planner that you think the value provided can certainly, well outweigh, the expense, because there is an expense to working with anybody who's providing a service to you, but that value, has to be realized. So what are some areas where
Yeah.
you think people might not even be considering where someone like yourself could add value?
Yeah, and just to be abundantly clear, Jason, by you're asking me, you're not endorsing me or my firm. You're just
Yeah,
asking for a perspective, right? And I think
absolutely.
that's great.
Absolutely.
So I would say two things. One, you want to be thinking about the different areas of your financial life and then you want to be thinking about the gating decisions, right? So I think financial planning got this sort of investment focus over time.
Oh yeah.
And frankly, to my mind, investments are just one aspect of our financial lives. And I don't even know that financial planners add that much value there, to be honest with you. Look, financial planners have great insights and can add some value, but boy, in that investment space, the value add I think is somewhat limited.
Yeah.
Um, I think you want to be thinking about where am I in my life on things like estate planning,
Yeah.
things like insurance planning, things where things could go a little south in my life. And do I have some knowledge here? Have I worked with other professionals here?
Right.
And if I have, great, right? And I'm confident with my situation, my arrangements. I don't have much gaps. And look, it's hard to say, whether you do or don't, but you can do some of your own analysis in that regard. And if you say, boy, I never even thought about doing insurance planning or what gaps I might have in my life or what happens with my assets if I die and what about my little kids and all that, boy, that might mean you might want to call up an advice only financial planner and get some strategic advice in those regards, right?
Yeah.
And financial planners, don't write wills, don't write trusts, don't sell insurance, but they can help from a strategic perspective be someone to say, well, strategically, this is what I'd want to have in place. You now might need to go consult with a second professional, a lawyer, an insurance salesman. That's okay too. So that's one area where you want to look at where are you today and just how comfortable are you with where you are today. And then the second thing is gating decisions, right? So things like, hey, you know what, I might be 6 months out from an early retirement. Maybe now is the time I have a advice only financial planner go through my numbers, go through my situation, go through my gaps, insurance, estate, drawdown strategy, whatever it might be. And that could be a time too. So when these gating decisions come up, am I going to early retire? Am I going to start a new business? Is my business growing? Right. So
Right.
maybe I went out in self-employment and for first couple of years, I'm struggling along. And now year 3, things are popping. Well, that could mean you need a new financial plan. Maybe I'm thinking about something like a rental real estate venture or something like that.
Right.
Maybe now's a time to assist, right? So, yeah, it's hard for me to say, okay, here's exactly when you need a financial planner and
Sure.
when you don't. And DIY is perfectly, legitimate. And frankly, everybody who has a financial planner is doing some DIY to some extent,
Absolutely.
right? Because I like to tell clients, I'm the advisor, you're the boss, right? So I can make whatever recommendations I want to make. At the end of the day, they themselves have to say, well, I agree or I disagree. And
Right.
hopefully they understand why they agree or disagree.
And I'm very appreciative that you've given up so much of your time, Sean. As I mentioned, we will certainly put a link to the book in the show notes. I wish you all the best with it. It's clearly a great resource. I'm convinced of the value of a solo 401k. We'll certainly describe some of your other episodes as well of your show, of YouTube, as well as some of your blog posts. Definitely encourage people to check them out. From my observations in all social media, Reddit, Discords, anywhere I spend time in the FI community, there are many, many tax questions, and clearly your blog is a great resource. So would highly recommend people check it out and check out the book. And thank you again, Sean. Really appreciative of your time. And thank you for what you do for the community.
Jason, so great to chat with you today. Thanks so much for having me.
Thanks. Take care.